Hello, welcome back to Primary Source China Investment. We are on show H. Peng.guo and I are excited to be here. We sincerely appreciate all of the feedback and try to incorporate that feedback into the next show. And with that, as usual, we have a lot of ground to cover, and we're going to get into China policy. And today in China policy, we're talking about core interests. At the Bao'an conference, we heard a lot about conflict, and Xi Jinping specifically was mentioning that there will be more and more conflict between nations. And we wanted to understand, why is this conflict coming up now? What's the source of that? And a lot of the source of that is what's called core interests. And core interests as a concept began in the early 2000s, and Hu Jintao grabbed onto that concept, and now Xi Jinping has really put it in all of the formal documentation from CCP. And what does it mean? Largely based on land claims that China believes is part of China. So Taiwan, there is one country. Taiwan and China is one country. That's the position. The other is one country, two systems, which is Macau and Hong Kong. Another is Tibet. Tibet is part of China. Another is Xinjiang. So all of these things are related to territorial claims or historic claims. Now, we don't want to get into the historical veracity of this, because a lot of the historians are going to point out that, well, in 1858 and 1860, China ceded a huge chunk of land in the Northeastern Asian region to Russia. There's been a history of ceding and grabbing back, and these core interests are exactly what China's putting a red line in the sand and saying, this is our no-go zone. And a lot of companies are running into trouble with that. So if we give an example, remember H&M. H&M ran into a problem with the Xinjiang cotton. So H&M is at a position and a size where they can run their own supply chains, run their own factories, and not abdicate responsibility and put their hands up and saying, well, I don't know where my cotton comes from. That's a cop-out. H&M, if they're worried about where their cotton comes from, they should go build a cotton plantation. They can own the supply chain in China. And a lot of companies have done this because they've gotten into trouble. When you're in a race to the bottom on price, there's a lot of shortcuts, and foreign brands can't take those risks anymore.
I think in my understanding, what really core interest means, it's like the red line. So if you cross the red line, you will see the fight back from the China. And obviously, if you cross a red line, no matter what kind of the suggestion or opinion, China will treat it like the attacked, like deadly attacked. And so this is we try to avoid it. From my experience, I really see a lot of things is really came from the misunderstanding. Yeah, so China and the United States are really the two different systems, different culture, different history. Unfortunately, those two countries, most of the people, they don't understand the history or belief of the other countries. I think the Western side is don't understand why China want to keep that one country or not. Because of the China history, they suffer almost 200 years of the civil war and a lot of the painful experience with that. If you touch it, it's really like the open the scar of the China. It's painful. I think, it's easy ways to avoid it. Further things is to try to get the some local partners suggestions. And in the current situation is if we see the global public opinion is really controlled by the Western side and Western media. So China is they have no place to give the voice. They have very limited place to give the voice, to give the opinion. That's really a lot of things reported for the people. They really came from the media. So if the media have difficulty to report the fact, report the truth, that is of course a lot of problem for the misunderstanding. But if we believe we do the right things, we really need to work together and spend time to communicate. Yeah, so my suggestion is,
last time you said something important. You said politics is politics, business is business. And there's no company that's going to solve the 9-line problem in the South China Sea. No company is going to solve that. So that's up to world leaders, and that's up to the countries that have an interest there. So, there's no reason that companies need to take a political stand about that, because these issues are going to be solved politically. They're not going to be solved on a business side.
Yeah, I think another worst thing is try to motivate the people, get more companies to join the process. That's really unfair. So we pay the tax and get hired officers. That really should provide a good international business environment, rather than just simply they get the financial resources, they get the other resources to fight each other.
I look at the language that the politicians use. President Biden and Prime Minister Suga just had a conference, and the language that they put out. I mean, Twitter was all a Twitter about this language. But if you parse the language very closely, and we'll put up the exact quotes, the language didn't move anywhere. It didn't move forward. It didn't move backward. It was language that could have existed for a long time and didn't deviate from anything in the past.
Yeah, I think right now is really people really suffer the COVID-19 natural disaster, and each country, they have their own tons of the problem. It's very hard to even maintain the current living standards. So we can see the things get worse, and then right now people get oversensitive and overreaction.
Sure. Well, we hope this provides a little bit of color about what these core interests are, the beginning of them, and how China is using that as a red line in the sand to say, look, if you foreign leaders or companies want to talk about these things, there will be consequences. And we've seen that played out in a number of different areas. So with that, we're going to move on to capital markets, where we're going to talk a little bit about those large US ETFs and what are they actually holding. In the past, we've thrown up some charts to show what those ETFs hold, but we didn't really talk about some of the companies. And some of our viewers may not be familiar with what these companies actually do, and then what kind of exposure you have when you own these ETFs. And as our viewers know, the CSI 300 is not a great investment on a risk-adjusted basis. And we wanted to cover some of these large ETFs. And what are the largest ETFs? We're going to put a chart up in some of the large mutual funds as well, because there's a few large China mutual funds. So MCHI, FXI, KWEB, ASHR, all of those are top AUM ETFs. There's also FHKCX and MCHFX, which are the two largest mutual funds. These funds have massive exposure to technology, and there's a reason for that. The tech companies that have come out of China in the last decade or so have been massive performers. They've been innovators, they've had global reach, and we're going to get into some of those because some of our viewers may not be familiar with what these companies actually do. But first, we're going to start with the largest name on the A-share ETF. So if you own an A-share, pure A-share ETF, you're going to own a lot of Maotai. And what is Maotai? Well, if there's anything like a national drink, Maotai is it. Distilled from red sorghum grain, it produces a white liquor of about 100 proof. It's still the most popular drink when heads of state visit. When Kim Jong-un visited Xi Jinping, that's what they drank. The brand is associated with gifting. So while the younger generation may not prefer it at their banquets, it is the preferred choice of a gift. So that's the largest holding. The second largest holding in the A-share market is Ping An. Ping An originally started as an insurance company, and it's a sprawling financial services company now with insurance, investments, healthcare, real estate, technology, and on and on. Ping An is considered a private company, but it was founded as a state-run enterprise in 1988. And the largest shareholder is Shenzhen Investment, which is a state-run fund. How big is Ping An? Well, they have 220 million retail customers across all businesses. That's massive penetration. So those are the two largest names on the mainland. There's some other financial services, like the third one is China Merchants Bank. And there's some other financial services, but those two are the largest ones. Now, for those considering Greater China, the largest China ETF, bar none, is MCHI. And the top three holdings of that are Tencent, Alibaba, and Meituan. The largest holding is Tencent. For those of you who don't know, ask your kids, because Tencent, through subsidiaries and some other deals, owns a piece of Fortnite, League of Legends, and Call of Duty. Those are the three largest games on the planet. Add in WeChat, the ecosystem on your mobile phone, which gives you access to everything like social media, payments, healthcare, your even COVID status, and you have a massive company with a worldwide reach. The second largest is Alibaba. Not sure there's too much to add here, but there's actually 3 e-commerce sites: Tmall, Alibaba, and the biggest, which is Taobao. It's the largest e-commerce site in the world. The financial services arm that Jack Ma slyly peeled off is no longer part of the company. And the third largest is Meituan. This is offline to online service juggernaut. So if you want to get a haircut, you want takeout food, movie tickets, a hotel room, groceries, Meituan Dianping is the service provider for this. Finally, if you're looking to include China-based companies that are listed in the US, the 3 largest are JD.com or Jingdong, Baidu, and Pinduoduo. JD.com, while Alibaba is the largest e-commerce site, JD is the largest retailer in China. Started in 2004. Jingdong is a logistics powerhouse. And since they provide almost every imaginable product, they need to build out that huge logistics business. Second is Baidu. The China search engine is the 4th most visited website according to Alexa. That's a lot of ad revenue. The company's expanded into AI with some mixed results. And the third largest, which people may not be familiar with, is Pinduoduo, founded in 2015. It's the largest agricultural marketplace in China, connecting farmers to buyers and making huge improvements in the supply chain. Final note, ByteDance or TikTok is still private, but it's got a huge valuation. So as you can see, there's a lot of technology here. Well, there's a lot of Baijiu and there's a lot of technology, maybe too much exposure.
And that's right. From the traditional portfolio construction theory, so we know we should diversify rather than focus on a few companies. So that is based on the theory. In China, like the Tencent is not just a larger company, it's also probably the largest venture capital. So they invested, they sponsor lots of companies getting online. This is why the valuations actually include a lot of the stakeholders from other area. Maybe you are more focused on the technology area, but we know the technology is always like the high beta. A good way is always make like the sector analysis. So there's not too many sectors. You can easily to figure out what's the holdings highly related to which sectors. After you understand that, a good way is try to select the different sector to construct the more balanced portfolios. Finally, it's really you hold like the technology sector. You have to use what we use that we call the hold the uptrend of that sector. Otherwise, if sector tends down, you will get hurt.
Right. The uptrend and the downtrend, you have to be obvious about this. This is an important aspect of when you say it's high beta. You also have a lot of this non-systematic risk. We just saw Alibaba get fined, and there's probably a high chance that some of these companies are going to break up. Some of them may merge. Some of them may go away because there's going to be new winners and new losers. As you can see, some of these companies were just founded in 2004, 2008. These are newish companies. So that type of exposure to that sector is going to bring a lot of volatility with that, particularly when some of these ETFs have 45% allocated to tech only.
That's right. Individual companies, they do have the much higher unsystematic risk. It's really the risk from the corporate itself, like the corporate governance. You just said, Jack Ma leave the company, and also they face the fine from the country. You should think about diversify this kind of the risk.
Right. Well, it's important to understand what you own. So blindly getting exposure is not the methodology we would advise. And I know it's getting more complicated to invest in China, but you do need to do a little bit of due diligence. You need to know what you own and take responsibility for that. So with that, we're going to end it this week. We appreciate everybody giving us comments, appreciate everybody hitting that subscribe button, and let us know if you have any questions or issues. We're happy to respond, and we're easy to find. Thank you very much this week.
Thank you.